Like to welcome you all to Tideway's New Year investment webinar, when we reflect on the year gone by, but also look forward to the year ahead. My name is Seymour Banks. I am delighted to be able to welcome this evening with me James Baxter, the founder of Tideway, who many of you will recognize, I'm sure, but also Nick Gate, who's our head of fund manager research. Nick's been with us for over 10 years now. And to get the ball rolling, but also to give you a chance to put your own questions on the screen, I have two of my own. Firstly, for you, James, we did this investment webinar, New Year's investment webinar last year, and we were talking about a new era for income investing as quantitative easing was coming to an end. We looked also at the increasing opportunity set for fixed income. I guess the question for you is, to what extent did interest rates play out during the year as you were expecting, and markets as well?
Great. Well, thank you, Seymour, and Happy New Year to everybody. So I guess we came off the back of 2022, which was definitely the annus horribilis for fixed income. We obviously had, one of the biggest corrections in that market ever. I think it was on record, Nick. It was the worst ever. And so, our biggest concern was, had it finished, were we through it, and what was going to happen next? And we thought we were through it, and we were looking at much more attractive returns from that sector. And we sort of made the bold statement that we thought fixed income was probably the best and most attractive market for us to invest in terms of a combination of certainty of returns and the returns that we might earn. And in the end, it played out well. So it didn't come in a straight line, and we got off to a very good start. Then there was a threat that inflation was going to be much higher, but in the end, inflation did start coming down. It came down first in America, and then it came down fairly strongly in the UK as well. And as inflation came under control, it became clear that interest rates would be able to go down, and that we'd reached the peak of longer term interest for the short term. And so all our fixed income funds did reasonably well. And in the end, we ended up earning somewhere between 8 and 13% on our fixed income funds. And that was, we earned on the short dated funds, we earned on the high yield funds, and we earned on the investment grade funds.
Over to you now, Nick. Perhaps a question in a little bit more detail in terms of the underlying portfolios. To what extent did the investment managers meet your expectations, both across fixed income and equities? And specifically, what changes did you decide, or did you actually decide to make during the year? And why were those changes made?
Sure. No, thank you very much for the introduction there, Seymour. Yeah, I'll reiterate what James has said there. So our portfolio returns were driven by our fixed income investments, ranging from the short duration to the longer duration end. As James mentioned, everything between the 9 and 13% range. Obviously, with the yields starting where they were, and with inflation at 10%, I'd say this is slightly more than we were expecting throughout the year. So yeah, we were very happy with that. We can discuss this in more detail later, but as well, our global equity managers, through analysis of the fundamentals and valuations, also perform very strongly. In particular, our two high conviction global equity managers.
Yeah, the first question that we have coming through, I'd be interested to hear Tideway's view on what investment themes we can expect in 24-25 as central banks reduce interest rates and their plans to reduce their balance sheets following the end of QE. That's a general question, but also as a follow-up, specifically the investments Tideway thinks will perform well. James, would you like to kick us off with that one?
Very good. Yeah, so I think the way I'm going to try and just talk about this quickly is to look at, if you like, the positives and negatives. So what we're seeing in the positives is that we seem to largely have escaped recessions around the world. So we're heading for what's known as a soft landing, the sort of Goldilocks effect, where it's not too hot, not too cold, but just right. We are definitely going to have base rates falling. Well, almost certainly going to have base rates falling. The market is telling us that we should expect base interest rates in the US and the UK to fall fairly sharply in 2024, and that's usually quite good for assets when interest rates are falling. Inflation looks under control, so we have got inflation now under 4% in the UK, heading towards 2% in the US. Actually, if we looked at inflation on a month-by-month basis, it's probably gone zero. It's only when we look 12 months in arrears that we end up with a sort of positive number. So inflation has definitely cooled dramatically. And then we've got some quite big drivers for economic growth. We've got, you know, the drive to net zero, which is a sort of big infrastructure investment that economies have got to deal with. And, you know, potentially this new era of computing with AI. So those are the positive things. The negative things, it's not hard to look for risk, and we have got definitely a lot of geopolitical risk going on around the world. We've got 2 wars going on, and you know that those both have the potential to flare up very nastily. You know, we've got tankers not being able to get around various capes, and so the risk of supply chain dislocation is coming back into light. And then there's also another risk out there, which our macro analysts are very attuned to, which is that we might actually get a bubble in fixed income. So if interest rates come down too fast, too quickly, and then inflation sort of re-emerges towards the back end of 24 and maybe into 25, we could actually see interest rates going back up again. So, you know, those are the kind of positives and risks that we see. And I think from our perspective, where are we keen to invest? Well, we're keen to invest anywhere where it looks like there's good value to invest in, and there isn't a bubble in value where we might get you know, sideswiped with a big loss. And for now, we think the fixed income is not in a bubble, so we're still very nicely optimistic about our fixed income returns. We absolutely don't see another 2022 situation. So, you know, we've got forward-looking yields of between 5.5 now on the investment grade, maybe 8.5 on the high yield stuff. So we're expecting returns on the fixed income in that sort of era. Might be a little bit more if interest rates do come down and inflation goes low. Might be a little bit less if inflation starts to pat back up again. But we're very confident in fixed income, and in equities we like all the stuff that hasn't gone up massively high. So, you know, we like small caps, we like value, and we like lots of stocks, but not necessarily some of the most expensive stocks on the planet.
Said there was a second part to that, specifically the investments that Tideway thinks. Obviously, James alluded to the general areas, but in terms of managers, Nick, is that reflected on what our managers are thinking?
Yeah, absolutely. I mean, I think the important thing to note is, yeah, the market is already heavily pricing in rate cuts for 2024. And so it's very much the asset classes which have already priced in the soft landing versus those who have not. So yeah, as James mentioned, on the smaller company side, we have exposure there through 2 managers, infrastructure, which wasn't mentioned, and also, yeah, certain segments which would constitute as value sectors. But yeah, just a reminder, our managers are all active managers, and we construct it with a global view at the top. So yeah, our 2 core global managers, Heriot Global and Schroder Global Value, have full shrift to move around as they see fit.
It's quite interesting. We've got obviously a number of questions coming in, and similar to the third part of that initial question, which is really around headwinds for investors, mainly geopolitical. Talked about Ukraine, the Middle East, more recently, and especially elections. Just had an interesting result in Taiwan. Obviously, many elections coming up. Just for the moment, though, we've got a question coming in. 2024 is likely to see some sizable events, and within elections, not just abroad, but also within the UK. The continuation of conflicts, I guess the big issue is to what extent we see an escalation of conflicts, but also climate impact. The question following for that is, how are Tideway considering and preparing for potential shocks?
Let's divide it into 2. Let's look at the UK stuff first. So, you know, we have to get into our heads that we are, whether we like it or not, that we're international investors now. So when we look at equities in particular, I mean, what did you reckon our exposure to UK stocks is down to?
So just an overview of where our allocations are. So The US makes up the majority of our equity book at close to 50%. And this is a function of how global indices are constructed as well. Our allocation to UK equities is only 6%, with the next highest representation being Japan at 5%.
So if we were invested in a load of UK house builders, for an example, or businesses which are exposed to the domestic economy and to domestic politics, we would of course be very worried about the election. But I think we're much more, as far as the election is concerned, we're probably much more focused on the taxation of our portfolios rather than the investment returns on our portfolios. So the one thing that governments, and new governments in particular, can't stop themselves from doing is fiddling around with taxes. So if we get a change of government, probably the biggest aspect will be, how it impacts the taxation of the returns of our investors, and whether they change pension rules and what do they do with inheritance tax and all of this sort of stuff. I think from an investment perspective, I think somebody said to me this morning, actually one of our clients, that every new government would have seen what happened to Liz Truss when she ignored advice and took some bold steps without necessarily quantifying them. I don't see any other government coming in being too free and easy with the UK economy, to the extent that we suddenly don't look like a bankable economy, or that our government bonds aren't sustainable or anything like that. So we're not too worried about the UK blowing up as such with a new government, but I think our focus would be very much on where the tax hits are going to come. On the risks, which was the other point, and we are, risks always come from something we weren't necessarily expecting, and so we should always be looking out for them. I mean, we hold Ruffer in the portfolio. We bought that, and that fund is absolutely our insurance in the policy for big risks.
So I'll jump in there. I mean, we had a question before the session started. Why hold Ruffer? So Ruffer is in the portfolio. Ruffer Diversified Return. Ruffer is in the portfolio as James mentioned, as portfolio insurance. It routinely shorts equity markets and other risk indices in order to hedge against major unforeseen risks. So this is this is very much part of our risk planning. And just to give a few previous examples of where Ruffer has held portfolios. So Ruffer has been running the same strategy for 27 years. It only runs one strategy, and that is with the aim of not losing money in any one year. Last year was an exception, one of 2 years in 27 where it had negative performance. But during major blow-ups, dot-com crisis, global financial crisis, and the market moves in the immediate aftermath of COVID-19, the fund performed exceptionally well. Just to give some idea of numbers there, in the dot-com crisis, where the FTSE All Share was down 15% in 1 year, it returned plus 5% to investors. The global financial crisis, where again the FTSE All Share was down 20%, the fund was up 15%. And during COVID-19, the initial phase where equity markets were down 13%, it achieved a positive return of 13%. So meaningful outperformance. Although I've labeled it as insurance, I mean, since 1996 and the portfolio's inception, its annualized return is 8%. So it's a nice diversifier for portfolios. And we think, should one of these unforeseen blow-ups happen and a major correction in risk markets, this fund will do very well and be a source of capital which investors in drawdown can count upon.
People are asking how we might change the portfolios through the year, and this is always an interesting question. And I think what's been good about 2023 is it's given us the massive lesson about staying invested and being calm. So, we got 90% of our return in 2 months in 2023. And if you start trying to be too clever, jumping in and out of investments, it's so easy to miss those months or weeks where, the returns are really strong, and then you're never going to get that opportunity again. So if you've missed it, it's gone. So, we can say quite categorically now, we're not going to be jumping out of investments into cash on the back of, an election in the UK. It's just not going to happen.
So we've got a question here, James. Assuming an October election under different scenarios of a Labour victory, what, if any, adjustments will be making to the shape of the DD1 to DD4 portfolios, asset class and geography, to reflect your views on this?
Yeah, so it might, it might not change anything in election. I mean, what's more likely to change the shape of the portfolio will be the progress of inflation and interest rates. I think we're going to be much more influenced by whether or not we see an uptick in long duration bond yields, or we see base rates coming down very low, or base rates don't come down. Those sorts of issues, which to an extent will get driven by, will be influenced by an election. I don't, unless we come up with a bright idea, we're not going to speculate the portfolio around an election outcome at this stage in the game. And that was actually one theme that we wanted to try and uncover as this broadcast goes on, which is to try and differentiate the difference between speculation and investing. Now, if you were speculating purely on the passage of the S&P 500, or you were speculating on how particularly the FTSE 100 might behave in 2024 around an election, then yes, you'd want to have views on what was going to do. But we're not really doing that as part of our investment process. We're trying to buy fixed income investments which are going to pay us 7 or 8 or 9% over the next 4 or 5 years, and we're trying to buy equities where there's a good case that they're going to increase their profits, increase their dividends, and get more valuable. We're not trying to buy things that are so highly valued that they're heavily dependent on fear and greed as to how the price moves on a daily basis.
We've got a question here regarding the US market and the outlook for the US market, but that reflects also a more detailed question that we got earlier, which I'd like to read. It's how are you evaluating your previous posture of being relatively light on US equities? Nick, you mentioned we had roughly 50% exposure. I understand that there are concerns that US stocks are highly priced. The index is hugely dominated by the Magnificent Seven, and we've got exchange rate issues, obviously. But as a long-term proposition, it seems clear that US firms will remain the driver of global value creation and innovation, and performance compared with the UK European indices, at least, that's indices, not corporates, is consistently strong. How would you like to answer that one?
Yeah, I mean, one point I do have is I think it's very important to differentiate between the domicile of listed businesses, US, Europe, and where their revenues are based. We hold no passive investments outside of the US, and I think there are opportunities in European businesses, especially, which are European only in name, but yeah, receive the majority of their revenues from the US. My best example is with the MSCI Europe. Again, we don't invest in it, but it's telling, where less than 30% of their revenues are actually received from Europe, and roughly 40% from the US. They also have some exceptional businesses which the US index doesn't contain. So like the US has these Magnificent Seven tech companies, Europe is particularly strong in luxury goods, for example, and also healthcare, among other things. So there's no Novo Nordisk, for example, in the US index. There's no LVMH. So I think you should look at it more on a revenue basis than just where the actual businesses are listed. And
I think it's fair to say LVMH and Novo Nordisk themselves are leaders in their own field. So it's not just in the US that we see companies. Obviously, tech is a big area that we do, but not throughout the whole marketplace.
Yeah, I'll add to that. Listen, our asset allocation is very nimble. As I said, we construct our equity portfolios with 2 core global managers at the top, and within their mandates, they look for the best businesses in the world, which fit in with their investment mandate. So if they themselves, the managers looking at these individual companies, are seeing better opportunities in Europe rather than the US, it moves our allocation.
I said it right at the start, the introduction, 2023 was a big year, a lot of hype around artificial intelligence and technology. Question here is, what is Tideway's view regarding investing in AI technology?
Look, I think, and this all ties in with the previous question, which is around the US index and its makeup, and this Magnificent Seven, which we were actually saying today is probably a magnificent one, a dodgy one, and 5 pretty nice businesses. So the magnificent one really being NVIDIA, which is the one that's leading the way from AI. So they're basically designing microchips. They're not making them. They're sending them out to Taiwan to be made, and they have a huge profit margin and a huge growing business in a rapidly expanding market at the moment. So they look eye-wateringly expensive. We have exposure to them through our index fund and probably through some of our other managers as well. And that, you know, that has been the stock that's probably kept the or surprised the active managers over 2023, and they just haven't been able to keep up with it because of 6 or 7% exposure to that stock, which doubled 200% up in 2023, I think.
239%.
239% return in 2023 is a massive contributor to the index return. Then we've got, you know, the dodgy one, which is Tesla, which nobody quite knows whether that is, you know, an accident waiting to happen or something that's going to transform our lives in years to come. You know, will they get autonomous driving off the ground? Will we all have robots looking after us in the next 2 or 3 years? Who knows? But, you know, that obviously is being seen as a play potentially on AI. And then you've got somebody like Microsoft who's doing incredibly well at exploiting everything around AI. You know, they're into everything. And then there will be other companies, you know, there's this whole piece around, as we saw with the internet, you know, there were a lot of people who didn't believe in the internet. The internet now is everywhere. And it wasn't some of the internet.com companies of 99, 2000 that ended up making a lot of money. It was more traditional businesses that moved their businesses online. And so, you know, what we expect to see is some companies really being able to cut costs and improve productivity through the use of AI, who may be able to kickstart their businesses into a new arena. Undoubtedly, you know, it's why we invest in the US to a large extent, because you know, that is where a lot of the action is taking place, and that's, you know, why we are 50% of our equity weighting is in the US.
In terms of the wider perspective, though, in terms, you know, impact of AI, and you mentioned it right across all sectors, it's not just AI companies themselves. Nick, do you see that as a reflection when you speak to your managers, when they're actually looking at investing in different companies? Obviously, AI must be at the forefront of their minds. How do they perceive it?
Yeah, absolutely. I think it's important to take a step back, and AI has come into the general market consciousness only in the last year with the advent of ChatGPT. But the reality is that these managers and the companies have been looking at AI a lot longer. You can go back and look at the annual reports of companies on this. I mean, I don't think it's difficult to understand mundane companies the advantages of harnessing this. So my thoughts are it'll be the adoption of AI will be equally as important as those enabling AI.
Exposure to UK fixed income similarly low. I guess that's an allusion to the fact that we have low exposure to UK equities.
Yes. So the answer to that, of course, is no. So when we invest in fixed income, we don't want the exchange rate risk. So we tend to invest predominantly in UK fixed income, although we will invest in euros as well, and in some cases in US bonds. But typically the managers will hedge those currencies back into sterling. So they're trying to deliver a pure sterling fixed income return. We're trying not to, not to be moved around too much by currency exchanges. Now, that may have been a disadvantage historically, because obviously it's been good to be in the dollar. The dollar's been relatively strong. But more recently, that's been a bit of a headwind for international bond funds. So I think, most of our clients are spending sterling. We do have some clients who spend in dollars and euros, and so we will take that into account in the construction of their portfolios. But if you're spending money in sterling, you can rest assured that we're mostly investing in sterling.
James, nice comment as far as your updates, your weekly updates, bi-weekly updates, I think probably is correct, have been very useful and informative. Will you have a theme for them this year? I mean, my observation is there's no general theme. You're very topical.
No, I think we like. I always like to think that. So I read the FT the day after, and hopefully we'll have picked out 3 or 4 things that will be in the FT on Saturday. I don't know whether any of you read the FT on Saturday, but I like to think that I will know roughly what's going to be in that paper in terms of some of the news events and some of the market moves that have happened in the preceding couple of weeks. And so, yeah, we'll see how it goes. We're down to sort of 2 weeks. I think we might do a little bit more on planning opportunities. You know, if we get a change of government, we may get a rush of tax changes, and therefore we may have to focus on tax planning a bit more than on investment management. But you know, we're generally happy with the way they're going, and they seem to be well received. So we'll keep up the good work, as they say. I mentioned earlier the propensity to get a bubble in fixed income and for markets to overcorrect. So for those who read my column, they'll know I'm acutely focused on the 20-year government bond yield, because that kind of sets annuity rates, and it sets also investment discount rates. So it tends to impact equity market pricing as well. So what we saw in the last 2 months of 2023 is that rate, having got all the way up to 5%, which was actually higher than where it got to with Liz Truss, it sold off all the way down to 4% in fairly short order. And then all that's happened in the first 2 weeks of the year, or first 3 weeks of the year, is it's crept back up to about 4.3, 4.4. And that is enough at the moment. I mean, there's been a few comments about all equity managers are having to become bond traders. That kind of move around in the 20-year interest rate outlook is sufficient to move market pricing. So, I think it's a combination of everything had gone up quite a lot. So what, things that can't go on up forever won't. So eventually it had to stop. And then you get a kickback in the yields like that, which kind of is a headwind for our fixed income funds. So they just go flat for a little while. This year, of course, we, compared to 2022, we don't think those kickbacks are going to be anything like as large. They may make our fixed income funds flatten off a bit, but they're not hopefully going to create big losses. And we have got these underlying coupons coming in on them. So overall, we expect the returns to come through as the year goes on.
Yeah, to add to that briefly, as James mentioned, large moves in Q4 last year. After the magnitude of those sort of moves, especially in the new year, it's not uncommon for institutions, individuals to rebalance their portfolios and or take profits. So again, speculation, but that could also be a factor.
Foreseeable future.
Give us some thoughts on a favourite fund of yours.
Yeah, the fund I like, you'd be happy to know, is Joint Top Conviction Equity Fund. It's managed. It's called Heriot Global. It's managed by Dundas Global Investors, based in Edinburgh. The beauty of the fund is it's relatively simple to comprehend. The investment philosophy, it has a unique investment process, and best of all, it's easy to monitor. So yeah, as James was mentioning earlier, I mean, we look for businesses which look at the fundamentals. They do this through the guise of dividend growth. There was a study commissioned by the Norwegian Finance Ministry and conducted by the MSCI in 2016. And it states roughly that as your investment time horizon increases, the fundamentals, i.e. dividend yield and dividend growth, account for or dominate returns. So on a 20-year period, 90% of returns are through dividend yield and dividend growth, and valuations don't really play much of a role.
A way of rounding up, first of all, just to make it clear, thank you very much for your attendance. We've had a great turnout this evening. When we look back on the last 3 years, certainly when we did this investment webinar last year, we looked back on 2022, and the focus was very much on economic issues, so around inflation and interest rates. 2023, we've already discussed in some detail technology and AI, artificial intelligence. I think, and it's been raised in a number of questions, when we look back in a year's time on 2024, the focus will be very much on geopolitics and the risks surrounding that, and the escalation that hopefully we won't see, but is looking increasingly likely. We were talking about Ukraine, now we're talking about Gaza and the Middle East. And it'll be interesting to see, following the Taiwan elections, the DPP being elected for a third time in a row. I think it's the first time that any party has been elected 3 times in a row in Taiwan. It's clearly not going to be much to China's liking. That said, I hope we've also helped to answer questions as to how we're going to, our portfolios are resilient in the face of what could be a number of shocks in the year ahead. That leaves me on behalf of Tideway to thank you, as I said, for your attendance this evening. Certainly thank you for your continued support. You know, our wealth managers, just to remind you, are on hand to answer any questions that you might have, not just on financial advice, but also your own individual portfolios. Finally, once again, thanks for your time to attend the webinar this evening, and I wish you all a very happy new year on behalf of Tideway. Many thanks.